your firm wanted to go forward with this. So to begin with the background on the R&D credit. So this is a federal income tax credit in the US. And I'll make the comment that most countries do have their own credit. So generally, each country is going to have their own credit to really incentivize spending with development, making the products, kind of looking to expand the marketplace within each country's own economy. What is going to qualify a company for this tax benefit is if the company is performing what's called QRAs, qualified research activities. So if you're doing those qualifying activities that do meet this 4-part qualification test, which we'll get into in a few slides, then that means that the company may be eligible to begin claiming this credit. In conjunction with having qualified research activities, you also have to be incurring qualified research expenditures. And again, we'll get into the details of that later, but essentially, if you're pairing having qualified R&D spend with qualified R&D activities, then you may qualify for the credit. There are 2 methodologies for how the credit is actually computed. We won't get into the details of that, but essentially we'll go through and evaluate for each company which methodology produces the better answer, and you can switch either methodology from year to year, depending on what gives you the better answer. The computation does rely on what's called a historical base amount. So effectively, it's not only considering the current year R&D spend, but it's also looking back to the prior year's R&D spend as well. And so as the credit spend increases from year to year, then your credit amount will also increase. If you flatline your spend or have a decrease in your R&D spend, you may still get a credit, but it won't be nearly as sizable as if you're increasing your R&D spend as compared to prior years. Generally, the return of every dollar is about 5 to 7 cents on the dollar. So for every dollar that you spend, you'll get 5 to 7 cents back in the form of an R&D credit. And again, this right now is a federal credit. It's a direct dollar for dollar offset to the company's tax liability. So in addition to getting a current tax deduction for your R&D expenditures in the year that you're looking at, you can also get a direct offset to whatever tax the company owes for the year. So now looking at utilization, how can companies capitalize on this credit and not just have it on their tax return, but actually reap the benefits that come with it? Well, the good news is, even if you don't have a current tax liability in the year in which you're generating an R&D credit, there is a 1-year carry back and a 20-year credit carry forward provision. So you have effectively 22 years, 20 forward, 1 the current year, and 1 going back 1 year, in which you can actually use this credit. Also, with the new 80% limitation on NOL deductibility, that does leave a small portion of tax that's still going to be due, even if you do have an NOL. And so that's where R&D credits can also step in and really help the company avoid having to write a check for taxes if you're cash flow negative or still looking to generate revenue for a certain year. Even better news is that most states within the US do have a state level R&D credit as well. And in general, this can effectively double your benefit. So if you're getting 5 to 7 cents on the dollar for federal credit purposes, you could even get 10 to 12 cents on the dollar if you're able to claim a state credit as well. Each state credit can be computed differently than the federal credit. States have their own rules, but in general, it's going to effectively double that benefit if there is a state credit. And on top of that, some states allow for transfers of credits. You can sell credits. You can even have credits being refundable. Again, that's very state specific. But for example, if you're operating in Georgia, you can even get a credit to your employee payroll tax withholdings in the amount of the Georgia R&D credit. So that's a great example of how you can utilize the credit without having to follow an offset to your Georgia income tax, for example. There's two other provisions that are also useful. One is called a qualified small business. So with this, if you are in your first 5 years as a company of having revenue, and your current year has less than $5 million in revenue, then you're considered what's called a qualified small business, or QSB. And that allows you to actually offset up to $250,000 of the employer portion of your FICA payroll taxes for the year. So that's a great way that primarily this is for startup companies that are in their first 5 years of revenue. And cash flow may not be very readily available. So this is an excellent way for companies to help reap the benefits of that, and it reduces your operating expenses. You can get refunds for those amounts, which has been very helpful for a lot of our clients. The last thing that I'll mention on utilization, so if you're considered what's called an eligible small business, meaning that the average annual revenue is less than $50 million for the prior 3 years, then this can offset what's called your tentative minimum tax. It's also known as AMT in general. Now, for corporations, this is not really an issue after or beginning in 2018. But if you're a partnership or an S corporation where you have individual owners within the company, then this can be a great benefit if any of the owners may be in AMT for a year. It can help offset that as well. So just to summarize, there's a lot of ways to effectively utilize this credit. It's not just you have to be paying tax in the year in which the credit is generated. Clearly, that's the best way to use it and easiest way, but there's multiple ways to capitalize on this tax benefit. So now we want to get into the qualification criteria. So essentially, what is required for a company's activities to be qualified for this tax benefit? This is where we get into what the IRS will generally call a 4-part test. So there's 4 tests that must be satisfied, and this must be satisfied for any project, process, software, technique, formula, invention, what the IRS will effectively define as a business component, just some component of your business that you're looking to develop, improve, create. And so again, it does not have to be just one tangible product. It can be a software technique and application. Maybe it's a new manufacturing process, a new formula for whatever you're trying to help figure out, develop, etc. So that's kind of the review of this, is really focusing on at the individual business component level, you have to satisfy these 4 tests in order to have that project or process or just that overall business component be qualified. The first test is called permitted purpose. So the purpose of this test must be for developing new or improved functionality, reliability, quality, performance. It has to be some functional attribute that you're looking to either improve upon or overall develop within your business. And this can be either used in your business or can be held for lease, license, or sale to customers. So it doesn't have to be something that's just sent to the marketplace. You could also use it within your own company. Being eligible for this is not contingent upon selling it or just the overall success. So if you try a new R&D effort and you for some reason fail or are unable to achieve maybe the specific results that you were hoping to achieve, that does not prevent you from being eligible. That's just kind of a side consideration. Furthermore, you don't have to create something that is brand new to the world or the US economy. It just has to be new to you as a taxpayer. So for example, if a competitor company has a new product that's been developed and you want to also develop that and sell it to your customers, but that competitor holds either a trademark secret, a patent on that, maybe it's something that you don't have access to. If you seek to develop that same product or process, whatever it may be, then that can also help you qualify as well. Test number 2 of the 4-part test is really where I like to think the R&D begins to start to kick in. So this is called technical uncertainty. So given that you're looking to develop or improve something that's functionally new or improved, you have to have some level of unknown or uncertainty, meaning that just because it's new, you can't know exactly how to go about developing or designing or building it. Because if you were to do that, then there's not really any research or development being required. It's just, let's do something new that we know exactly how to do. That's not going to be R&D. You have to establish that maybe you're uncertain as to the capability. So can what we're trying to develop do what we intend for it to develop? Or maybe can we even develop this? Is it functionally possible? Is it feasible? Maybe you look at the method of development. So kind of that, like that how question. How do we develop this? What software development methodology do we use? What form of manufacturing can we use? What type of engineering principles must we rely on to help develop this, and consider all of the functional considerations that will go into developing this? Or maybe it's just the overall appropriate or optimal design. So with what you're looking to design, develop, maybe you're uncertain as to, okay, can it fit in a small container that we have to ship across, the ocean to get to our customers? Is it going to function and be user friendly with the way that we currently have this designed? So effectively, it's kind of the if, the how, or the best design are the three primary uncertainties that we have to look at and make sure that at least one of those is satisfied for this test. Down below, we have sort of a side note, but this would not include general activities such as quality control testing, efficiency management, consumer surveys or studies, any advertising, or any non-hard science-based research, such as the social science research. These are going to be more of a routine operational or maintenance activities as opposed to development. The third test, called the process of experimentation, this builds directly off of test number 2, technical uncertainty, by essentially saying, okay, now that we have our new or improved goals, and we've identified our uncertainties related to the new or improved functionality, let's design and go through some iterative process by which we can test those uncertainties, test our hypotheses, figure out if what we're intending to do is going to work with the path that we've helped set forward. So for example, if you're looking to design a new manufacturing process, you might have your engineering team help design an optimal layout for the machinery, the equipment, to manage throughput time, to help get the overall automation working efficiently and correctly, the timing of each of the components working together. And maybe during the first trial run, you notice that there's 5 or 6 key design flaws. Then you go back, redesign, tweak the process, make it to where it's going to work eventually. It just has to be some process that you define by which you can test an alternative, a solution to your hypotheses or to your uncertainties to try and resolve those. And again, success or failure does not matter. It's just the fact that you went through this test in this process. The fourth part of the 4-part test, this is pretty easy for most companies, but it is a requirement. So effectively, it does have to rely on a hard science, as the IRS likes to say. So any kind of engineering, physical or biological science, chemistry, computer sciences, anything like that is going to qualify. If you're looking again back to maybe a soft science, such as a social science like sociology, psychology, any just general studies like that, those are not going to be what you want to rely on. It has to be backed by the hard sciences. So now we've gone through the 4-part test, I want to kind of walk through a few commonly qualifying activities that we see. And we do have some more slides following this that are specific to certain types of industries. But in general, if you're looking at just new product development, well, if you're improving upon existing or developing new products or technologies, developing new applications for even currently existing technologies, if you're looking to develop, design, build prototypes, models, pilot models, and then just conducting testing and helping improve, modify, tweak products to help satisfy even a regulatory requirement, those are all going to be related to modifying what is currently out there and looking to improve or even create new functionality. So those are four very common examples that we'll see with respect to new product development. As it relates to processes, the one thing that I'll say for processes first is that it doesn't have to be a manufacturing process. That's typically the most common qualifying process that we see with the R&D tax credit. However, it could be another technical process. So for example, there's a lot of companies right now that are doing lab testing due to COVID. And if they're having to design and develop automated, effective ways of testing for the disease that are going to eliminate waste, improve the results, that's an example of a technical process that may not be a manufacturing process, but it's also not a business process, such as maybe your accounts payable or finance related processes that we're looking to automate. But overall, if you're looking to develop or design a new technical process, if you're looking to refine, improve, re-automate, basically reduce scrap, make better, and then as it relates to manufacturing environments, again, going to maybe yield enhancement, automation, investing in new technologies to further build out the capabilities of your manufacturing processes, those are all going to qualify. And so kind of as a common theme of what you're probably realizing now is if you're looking to expand and do what your current products or processes cannot currently do, that's generally a good indication that you do have R&D. If you're looking just to kind of keep the lights on, so to speak, more of a maintenance type activity, making sure that you're doing repairs for a current process or product, that's probably not going to be R&D. That's more operational in nature. The R&D is really when you're looking to further seek out and develop new functionality. And then with software, it's very similar to the product category, but essentially if you're making a new software platform, a new software application, enhancing software features and capabilities, great examples of activities that may qualify. Briefly want to touch on a few of what's called the exclusion items. So there's 6 key areas that the IRS does call out. And they say, okay, well, if this is the case, it's not going to qualify. But want to spend a few minutes here and just kind of focus on some of the key aspects and what may seem like it won't qualify, but what it actually means. First one is research after commercial production. So this does not mean that once you issue a new software, a new product to the marketplace, that there can't be any more R&D. What it is saying is once you've reach that point of commercial production or commercial viability, then in theory, it's the R&D is done, at least for what's out there, because now customers can use it and it becomes more of an item of maintenance and operations. However, in recent years, especially in the software space, there's continual enhancements, developments, new functionality, and this also applies to products as well, obviously. But if you're seeking to refine a product that's out there and improve on that, that can definitely qualify. This is really just seeking to say that if you're trying to call activities that are really maintenance, if you're trying to call those R&D and there's not really any R&D being done, that's the main exclusion part of this. The next one is going to be adaptation of existing products or just business components. So this is really going to be very, very minor tweaks. Typically, it's not a technical modification. It's more going to be, okay, let's say that Apple has their new iPhone released, and now they want to change the color scheme of the phone. That's not going to qualify. It's really just putting a new color on a current product offering. That is generally what this is focusing on. If you're looking to actually further develop that iPhone and build new capabilities, new functionality, change the design, that can qualify. The next one is called duplication. This one is just saying you can't create 10 of the same thing and take the cost of all 10 and call that R&D if you've already established that the first one that you developed is, has satisfied the uncertainties and you've resolved those to further develop your product. So it's really just trying to prevent double counting of expenditures where you've already accounted for your R&D. Then we have, again, market research, routine data collection, routine maintenance. Again, those are more operational. This next one is key. It's called foreign research. So because most countries do have their own R&D credit, some countries have a rule where the R&D must be performed within the country or its territories. Some countries allow you to work overseas and still get a credit for those costs. However, in the US, the work does have to be physically performed in the US. Now, you can pay a foreign contractor for supplies or materials, and if those are used in the US, those can qualify. So the test is really, where does the work take place? And then the last one, which we'll get into in a little more detail, is called funded research. This in general is going to be if you're getting paid for the R&D work that you're doing, the IRS does not want you to both get paid for it through revenue or sales and also get a tax credit unless you can establish that you were financially at risk and you retained some substantial rights to what you'd help develop or work on. So we can get into those in a few slides. These next couple of slides are really focusing on just a few key activities and groups of activities for certain industries. So the first one, manufacturing, very, very common industry to see that they're claiming the R&D credit, whether they're developing new products or if they're improving on their current manufacturing processes. Maybe they're looking at researching, designing, developing, testing new materials, kind of a better input to your product, so to speak, or even better inputs to your technical processes. So this one, again, sort of a reiteration of prior slides, just a little more detailed with some examples here that may qualify. Within the software space, again, I like to kind of correlate this somewhat to new product development, if you will. It's just intangible. But software is a space where a lot of the activities may qualify. So all the way going back to the inception of a project, where you're helping define requirements, determine feasibility, those activities are focusing on, can we do this? How do we do this? Let's brainstorm and design. Then you go through the actual design and development. So the coding, building the architecture, choosing a platform to use to leverage if that's needed. Then you'll go through testing. So is our code working? Are the features working effectively? Is the user interface functioning and working and looking correct? And then once you get back user testing results, feedback, you can then go to redesign, rolling it out into a formal beta phase. And then once it's out completely, you can do continual updates and enhancements to that software. The other industry that we do see quite a bit of after manufacturing and software is going to be engineering. So this can be just pure engineering services, or it could even be engineering-based companies that look to develop new products for the marketplace. So this is fraught with qualified activities, because if you think about what an engineer does, they're essentially trained to help figure things out. Now, yes, they do other non-qualified activities, but the primary purpose is to help expand what is currently out there or what a company offers and seek to figure out things, find better solutions, better alternatives. So if you're looking to effectively, do your modeling, if you have a new bridge that you're wanting to build for a customer, and a structural engineering firm and a civil engineering firm have to go in and model out what that bridge may look like. Is it going to support the weight going across? Is it going to reach correctly? Maybe it's, again, feasibility analyses. So looking through, can we do this? How do we do this? Anything related to process automation, helping make products better. All of those types of activities are good examples of ones that may qualify. And a fourth industry that we have seen in recent years that's qualified is the construction space. So while construction may not, scream R&D, it does have activities that meet that four-part test. So if you think about it, if a construction firm is being contracted to help design and build a new commercial building facility, well, they're going to have to, take blueprints from an architecture firm unless they do that themselves. They're going to have to see, okay, how can we build this? With what materials do we build this? What does the foundation look like? What is the structural concern going to be at a certain height of the building? Are there wind concerns? We have to look at certain materials that are put in for the foundation, for the finishing models. How do we make the building more energy efficient, which is a very common consideration now. A lot of modeling, a lot of can we do this type activities. So construction is a very, very hot topic right now for the R&D credit, because a lot of companies have not been taking advantage of this, but certainly have activities that may meet that 4-part test. So briefly want to get into what's an eligible expense for this credit. So we have 3 primary types of expenses. That's going to be, well, I'll back up. We have 2 categories of expenses and then 3 primary types, plus 1 more that we've seen come back in recent years. The first category is going to be your in-house R&D expenditures. That's going to consist of anyone that's an employee for the company that is working on R&D efforts. So that's going to be primarily driven by employee wages and salaries. So effectively the time of the people doing R&D. You're also going to have supplies and or materials. So any of the supplies or consumables that they're using, the raw materials going into a product or whatever you're looking to design, develop, those can also qualify. And then the third one, which has been new in recent years, is going to be if you're paying others to use rental space for computers or servers, which generally is going to be in the form of cloud computing expenses now. This was designed back in the 80s when you had to physically rent server space from a large supercomputer, for example, but the same definition applies if you're using cloud computing space. So those are your 3 primary expenses that are going to be considered in-house. Then for the contract research expenses, that's going to be effectively the same types of activities, but they're paid to a non-employee. So if you're paying an outside engineering firm to do qualified research, that would qualify. If you're paying a third-party lab testing agency to help put together testing results and see, does our new product work? Is it going to pass certain requirements and testing? That can also qualify. And then with that, in the same category, if you're making payments to what's called a qualified research consortia, so basically it's going to be like a nonprofit that's going to be doing joint research, or you're making contributions to them to help further, find new products, develop new products, find solutions. Those can also qualify as well. And the theme here is that the activity that goes with the expense does have to be a qualified research activity focused on an overall new or improved business component. And so if that's the case, the expenses will likely qualify. With respect to wages, this is going to consist of not only that direct R&D, so it's not just your software development coders, it's not just your structural engineers. It could also be 1 level below as direct support or 1 level above as direct supervision. So if you have that direct R&D plus or minus the 1 level above and below, that time may qualify for the credit. There's also what's called a substantially all rule. And this says that if at least 80% of an individual's activities for the given tax year are qualified activities, we can include their entire wage at 100% as qualified R&D expenditures. And the wage that we use will be the box 1 amount on their form W-2, just their taxable wage is what we're using. And you can either use time tracking, or you can use a percentage estimate of people's year spent on qualified activities. So it's not like you have to have very detailed records that are explicit on what was done on a certain day. If you have it, that's great. It's not required. For supplies, this is going to consist really of any expenses that are supplies, materials, things that you can consume within the overall research process. This would not include, in general, land or depreciable property. So if you buy a $3 million piece of equipment for an R&D process, in general, that's not going to qualify. There are some nuanced ways that we could get to a qualified position there, but certainly the general rule is that it's not going to qualify. But if you're looking to build or develop a new product, any supplies or materials that go into that new product, those are going to qualify as supplies. This would not include overhead cost allocations. So for example, in a manufacturing environment, you might have your direct wages, direct labor, maybe your direct materials, but the overhead allocation, that would not go into this. However, if there's untracked wages, meaning that within your direct labor, it's only the time spent building the product, but not maybe the engineering time that's indirect, we can use percentage estimate allocations for their time, but the other costs that would go into overhead, such as your depreciation, your rent, all of your operating costs that are being allocated, that would not qualify here. Within this use of computers category, really the theme here is that it's going to be cloud computing expenses. So if you're paying Microsoft Azure, Amazon Web Services, or another cloud computing function to do development related activities, then that may qualify. If you're paying a hosting expense to host your software or whatever you're looking to provide to customers, that's going to be operational. But if you're using a portion of that space for development activities, that may qualify. And then going back to contract research expenses. So again, this is going to be for similar qualified activities as to what an employee is doing, except it's for a non-employee. This does require three criteria to be satisfied. One is going to be that there's an agreement entered into prior to the research being done. This can either be written or verbal. The second one is that you as the taxpayer, you have to have rights to the research results once the research is concluded. And then the third is going to be that the taxpayer must bear the expense even if the work on the R&D is not successful, meaning that you have to have financial risk with respect to what work you're outsourcing to be done by a third party. I want to touch briefly also on what's required for substantiation. So unfortunately, the language in the regulations for this is somewhat vague, which is both good and bad. It's good in the sense that it doesn't require overly burdensome record-keeping requirements. It could be bad in that if you go through an audit, the IRS may want to see additional documentation that maybe you didn't pull together, but maybe you haven't. It just may require having to go back and pull forward some additional pieces of documentation. But with this, the actual language here is that you must retain records in sufficiently usable form and detail to help substantiate that the expenditures claimed are eligible for the credit. What we do and what we see in practice is that you're typically going to have good quantitative files, so employee listings, either time tracking or percentage estimates for the employee's qualified time. You'll want to have either GL account balances or even account detail for supplies or materials. And then maybe a listing through your general ledger of contractor payments and any agreements that go with that. So that's typically going to be, from a quantitative standpoint, what we'll want to at least have when filing the return for one of these credits. And then there is a qualitative aspect that we'll get into in a few slides as well. And that's what helps really substantiate the activities, not so much the cost, but more so what were employees and contractors doing that made them eligible for this tax credit. And that's where we get into what's called contemporaneous records or contemporaneous documentation. This is very taxpayer specific. So again, there's not a very detailed requirement on what the IRS would require to see in the event that an R&D credit claim was audited. It just has to be any evidence that you have as a company that can help substantiate, okay, here's what we did, here's what these employees do, this is what our department looks to develop each year. Just things to help corroborate what we're trying to assert are actually occurring at the company for why a company is eligible for a tax credit. And then at the bottom here, use of estimates, just to touch on that again. You don't have to have very exact and detailed time records to the penny and to the minute. It just has to be reasonable and credible for what you're looking to include. And that's when you have the ability to try and put together some contemporaneous records and evidence that help support those estimates, as opposed to having exact time tracking detail in every case. So want to backtrack just a little bit and go into a little more detail on this issue of funded research, just because it has become more of a hot topic in recent years with the IRS. But effectively, what this says is if you're getting paid for R&D work, the IRS does not want you to both get revenue or sales for that work and also get a tax credit for that work. But if you can establish that you've met, as a taxpayer, that you've met these two tests, then it's effectively viewed the same as if you're internally funding this work. The first test, and the one that is much more, I would say, important, is called financial risk. So this is where, if you're looking at the agreement between the customer and you as the taxpayer, if you are unsuccessful in your R&D work, will you get paid, or will you have to repay payments made to you by the customer, or will you have reductions in the payments from the customer? Effectively, if you're able to do whatever you want, even if you try your best and you're unsuccessful, but you still receive payment, then in that case, you're said to not have financial risk if you're guaranteed payment for your work. However, if you would have to either fix the deficient work at your own expense until you get it right, or you just wouldn't get paid for the work if it's not successful to what the customer wants or requires, then in that case, you're said to have financial risk. The second piece is called substantial rights. So in general, it's going to be, okay, which party within the agreement either owns the IP or is allowed to use the IP if there is any intellectual property or rights to the research being performed. So this is not purely who owns it, it's who is allowed to use it without having to pay the other party some sort of royalty or license fee. So for example, if you develop a new product for a customer, but the agreement says that your customer owns the intellectual property rights to that product, well, if you're allowed to use some of the intellectual property that you developed in the future, whether it's for your own business or for another customer, then you're said to retain substantial rights, even though you don't own the property or the IP, because you do not have to pay your customer some sort of royalty or license fee to use them in the future. If you did have to make that payment, then you would not retain rights. So again, the theme here is if you can establish that you are financially at risk and you retain rights to work being done under a contract with a customer, then that funded research exclusion does not apply, and you're able to consider those activities qualified for this tax credit. Briefly here, what you want to look for is the contract evaluation. So you want to look at all the agreements, who has the resides or who has the rights to the results of the research, and then who has financial risk under the contract. Typically, that's going to be the contract type. So here in the middle of the page, that's the first indicator that the IRS will look to, is what is the structure of the contract. Typically, they like to see a taxpayer getting paid on a firm fixed price basis because they're only going to get paid a certain amount of money, and then the risk is on them economically to perform at that price. Whereas if you're getting reimbursed through time and materials, cost plus fixed fee, then in that case, you're essentially viewed as getting reimbursed for your work. The other thing to consider is not just contract type, but also the clauses within each contract. So you want to look towards any acceptance clauses, inspection clauses, rejection clauses, deficient work, warranty clauses, effectively anything that may talk about what the payment is going to be or how it may be affected if the work is not up to par per the contract requirements. And then going back to substantial rights, essentially, you just have to have the ability to use some or all of the intellectual property, should there be any, in some future capacity. You don't have to actually use it. You have to have the ability to use it. So to wrap things up, I want to kind of talk about what an R&D tax credit study looks like for taxpayers. So there's two components. There's quantitative and qualitative. So for quantitative, this is where we actually go through to help calculate what that tax credit is for each year in question. And that's going to consist of identifying where the R&D is occurring within the company. So certain departments, certain employees, certain projects for the year. And that's when we'll go and capture the wages, the supplies, materials, any contractor payments, any cloud computing expenses of their software. And we'll help quantify that. We'll try and do the cost by project if it's able to be allocated or estimated to a project. And then that goes through to the actual tax return at both the federal and state level. So that's what's required to file the return. Then in conjunction, but this may come later after the return is filed, depending on timing, but what you also have to do is have qualitative support. So you have to have evidence and narratives or just contemporaneous documentation of some sort that helps show how the projects that you're claiming are meeting this four-part test, are meeting that qualification criteria. So this could look like you have maybe a few interviews for some of your key projects each year, and you demonstrate how those key projects have met that four-part test requirement. You might also request and organize and review some contemporaneous records, artifacts, documentation to help build that out and help support that four-part test. Then we'll also have an overall project deliverable, which may include some guidance with respect to the R&D credit rules, a process memorandum, which outlines the process that we go through in helping to identify where the qualified work takes place, helping quantify those expenditures, who we interviewed, what the project looked like, how it all got put together. Essentially, that helps tell a good story for the IRS, again, if they're going to review the credit, to help them understand how the project worked, how things were quantified and claimed on the return, and what the support looks like qualitatively. And then finally, we have just kind of an overview visual of what this process looks like for the company. So what we do is we really try and tailor this process to be very taxpayer friendly. So while we do need a lot of data from each taxpayer to claim the credit, we always try and streamline this as much as possible to where it minimizes the business interruption and the need for time of your employees, because everyone's busy. We completely understand that. So it's a matter of how can we go in and get what is needed to where we effectively can claim the credit, have good support for that credit, but not overly burden the taxpayer and their employees. So for example, you'll see that early on, we're going to request payroll data, wage data, personnel data, some general ledger data from your listings, which is going to have supplies, materials, any payments to contractors, any project specific data. So we typically begin with finance, accounting to try and gather that data on the front end. Then we'll go through the analysis of that data, summarizing and organizing it on our end. And then we'll begin the process of interviewing certain technical people in terms of department leaders. Maybe it's an SME or a project manager that's going to be overseeing one of the key projects that we may choose to interview for. We might have them fill out time allocation surveys if there's not time tracking to help confirm that we have estimates of everyone's time that's doing qualified work. We will review some legal agreements such as contracts, SOWs between customers, third parties, and then we go through the process of actually claiming the credit on the back end, as well as getting the documentation put together to have ready in case this were ever to be audited by the IRS or a state taxing authority. And that is the end of this presentation. Bram and Brian, I know that we're up on time here for my part, so I will stop sharing and certainly happy to answer any questions after the call or after Brian's finished with his part.
All right. And I think I may actually be able to to share my screen now. Let's see. One second. I'm sorry. All right, there we go. All right. So as Brian mentioned, and can everybody, hopefully everybody can see my screen. Can you see it there, Will?
Yes.
Okay, perfect. As Brian mentioned, I am the accounting director for OMP. I've got 20 years experience in various roles, starting with auditing for 7 or 8 years and various private companies since then. So I came on board to OMP in October of 2019. Very focused on process improvements and so forth initially, but also looking at various tax projects and opportunities that could possibly be beneficial to the company based on where we are at. In the past, we'd been working with DHG on some amended returns, and so there are various initiatives that we knew we wanted to take a look at. However, until that time, we really didn't have the bandwidth to really look at additional projects, as we were just really trying to keep the lights on, as we had a finance manager that was wearing 3 different hats at the time, also as an operations or office manager and a HR manager as well. So we didn't really have the bandwidth. But once I came on board, that was one of the things I really wanted to kind of take a look at, was what opportunities might be available to us in terms of credits or other tax opportunities. I was also familiar with this R&D tax credit from my last role, and as we had a similar line of business with supply chain software as the primary product, and so I was kind of familiar with it, but I was fairly certain that there would be some sort of opportunity for us here at OMP. Let me, actually, I'm sharing the wrong thing. Let's try that again. Okay. So basically, as I won't steal any of Will's thunder with what he's already kind of gone over, but one of the things that would be considered, I would say, a barrier to entry for this is that a company thinks that, are we actually eligible for this R&D credit? Is it something that, do we actually have activities? Hey, we're a Belgian owned company, so maybe they're taking advantage of a credit in Belgium, so therefore we may not be able to, or we may not think we're eligible here in the States, or we don't have income, so we don't have federal income tax, maybe we're not eligible on that basis. Our company isn't focused on R&D, or we're not developing anything new, or our employees aren't degree holding engineers or scientists. I mean, these are things that could deter us from thinking that perhaps we're not eligible for this credit. And then additionally, kind of what I alluded to before or your accounting finance department is too small. We don't have the expertise to handle this. That's basically why we have engaged DHG to do this work. They do, as Will mentioned, they do the heavy lifting for you, and they'll also do exploratory research to see if you qualify, and if there's some opportunity to take. And in addition, the reason you engage them, obviously, too, is that if there's any questions by the IRS, or if they have things that they want clarification on, then DHG would, or the equivalent consultant would help you field those questions, as you wouldn't be required to address them yourself necessarily, but you would be, you would need to engage and provide the correct documentation if they were to ask for it, but this is all something that the DHG would assist with. So again, as Will also mentioned, this credit's available to companies developing newer, improved business components, but applies not only to product development, but also activities and operations like new manual processes, software development, quality enhancements, and so forth. So there's quite a bit of different opportunities that you could take advantage of, and activities that could be qualifying for this credit. So it certainly is worth doing a discovery session with DHG or an equivalent to determine if this is something that you can take advantage of. And in the case of OMP 2020, we just did our calculation, and I think we were close to around $200,000 of qualified credit that we're going to be able to offset against payroll taxes in 2021. Of course, this is going to be something that we'll be able to take advantage of, not only as a look back for the previous 3 years, but also because we just did the study, but also in years forward. So this is certainly something that's, worth taking a look at. And then I think, Will also kind of touched on some of this, but another deterrent could be that the credit could be, claiming the credit be difficult on my business. Are they going to have a bunch of extra work that they're going to have to do? I'm going to have to, get my software development people to provide a bunch of additional documentation, blah, blah, blah. So there's quite a bit of things like that might deter you, but generally speaking, we're not talking about an overly crazy amount of work. But it is, I think, for us, well worth that discovery and the additional documentation that we would need to put forth to qualify. And again, the first year of implementation, I guess, when you're establishing the credit, is the most work and the most discovery and the most questions. But then this effort will reduce quite significantly following that initial discovery, assuming that the business is staying relatively static and similar. You would just be updating what qualified R&D activities that your business is doing in those future years, and just kind of refreshing that year on year. And then the last thing I was going to say, just basically, my last bullet here is, there's this narrative that accounting and finance is just is necessary cost and not necessarily a value-added resource. But this is one thing that I always seek to do when I come into a new environment, or if I'm looking, to add value, is to do things like this. Look into tax credits, or we're doing a state nexus study that we're trying to just look for other opportunities to see if there's other savings that we can help generate and create value for the company. So that's basically all I have at this point, but I just wanted to share those things and my experience with this credit and the value that it carries.
Trying to share my screen again. Yes. Thank you, Will and Brian, for the presentations. If you're interested in the tax credits, I'll send the presentation Will gave to all of our members, so you can take contact and see if you're eligible. Because indeed, the information Brian gave, it can be a valuable resource if you're able to file for the tax credit. Thank you everyone for joining us. I'd like to end by plugging our next activity, network drink, Monday the 13th of December in the Belgian style brewery, the Baltimore Brewery at 7 p.m. on Monday. It's free for members. Normally you have received a promo code which allows you to register for free and get 2 free drinks. Else, if you're not a member, it's $10 and which will give you 2 drinks. All right, thank you and have a nice rest of your afternoon. Bye.